Tesla Insurance has the potential to drive trillions of dollars in value to the company. This video will break down exactly why. And if you're new here, welcome to the channel, The Paper Bag Investor. I've been investing since 2009 with about a 30% compound annual growth rate. I hope to achieve or beat that rate of return over the next 10 years and help others do the same. So make sure to subscribe if you get value out of this video. And by the way, nothing on this channel is personal financial advice. But all right, let's watch a clip from Pierre as he discusses some of the numbers around Tesla insurance.
Okay, so when you pay your insurance premium for your car today, basically 75% of the money you pay goes into financing the cost of risk. So that's the cost of the risk of you having an expensive accident. And 20%, 15 to 20% of the money, 15 to 20% of the money goes into, underwriting, managing the mess an insurance company is. And 5 to 10% is net, operating profits for the insurance business. So the cost of risk, if you sell insurance only to maniacs using the safety score and trying to improve it, is divided by 20. So 75% of the cost of your insurance is divided by 20. So let's say you want to keep half that profit for you and give half that profit as a cost reduction to your client. That means you can have an insurance premium in which the cost of risk, including your margin, instead of being 75, becomes 7.5. So you've more than half the cost of your insurance. Okay, and you make a monster profit already because half that cost is actually your profit. And then imagine Tesla building out its own infrastructure to sell insurance products, to underwrite them, look at how they do leasing and things like that. They will be almost an order of magnitude cheaper than an insurance company with its legacy. That's the way it is, that's the principle of fintech. If you do a bank purely based on web services and computers and all from a blank sheet of paper, you do things 10 times cheaper. So the 15 to 20% is also going to decline by maybe not an order of magnitude, but by 60, 80%. So Tesla will be in a position to sell you an insurance premium, underwrite for you an insurance premium that will be maybe half what another company would charge you, mostly because they know your risk profile. And by doing that, they will actually generate profits on that will be probably 50% instead of 10%. That's pretty cool.
Okay, so Pierre gave a really good sort of bird's eye view of the numbers around the car insurance industry. We're going to break it down further. So he said about 75% of premiums go to paying claims for a typical auto insurance company. And then 15 to 20% of premiums go to underwriting and administration. And then you're left with about 5 to 10% of premiums left over as operating profit. So that's kind of the breakdown: 75, and then 15 to 20, and then of total expenses, then 5 to 10% of actual profit. Now imagine an insurance company, if you would, an insurance company that only insured drivers that were 10 times less likely to have an accident. Tesla is such a company, or at least you can make that argument, because they have a strong potential to very accurately profile driver risk and price accordingly. For one, their drivers are already safer because they tend to use their own driver assistance software. And if you look at the accident data that just came out on this, they said they recorded one crash for every 4.3 million miles driven in the fourth quarter of 2021. Using their autopilot technology. And then we recorded for drivers not using that, they recorded a crash for every 1.59 million miles driven. And NHTSA's data shows that on average there's every 484,000 miles of driving that occurs in the US, there is an accident. So significantly safer, an order of 10 times safer right there between these miles and the miles, autopilot miles that are recorded in the US, let alone Tesla drivers themselves, tend to be safer. Maybe the vehicles themselves just tend to handle better and be safer vehicles. The second reason is that drivers are and will be motivated to drive safer because their insurance premiums will be cheaper. So they themselves will be motivated to learn to become cheaper or safer drivers.
I don't believe like there are good drivers and bad drivers. Anybody could be a good driver or a bad driver. But when you see that when you have a Tesla and you pay attention to your safety score, you become a good driver, a lot of people will want to do that. So it's going to make it even worse because individuals, the way they are being framed as good and bad by the old insurance system that is terrible, is going to become obsolete because a bad driver is going to become a good driver with Tesla and with a safety score.
And this is because Tesla really has the ability, to know, like no one else, to correctly predict someone's driving risk profile. Just think about it. They have a digital vehicle that can record many variables of driving. They have billions of miles of data, and that data's ever growing. And then they have camera eyes all around the vehicle, as one further sensor even, seeing exactly how you drive even in the environment, how close you are to the cars around you, even if you're not slamming on your brakes or giving other inputs to the car, which of course they also have. So they have this insane amount of data and variables that they could track for any specific driver. And their models seem to be working so far. This is from the Q3 2021 earnings call when Zach gave an excited answer about their Tesla insurance. He said, if you're in the top tier of safety score people compared to lower tiers, there's a multiple X difference in probability of collision based upon actual data. So far, even just the models they have an X factor in difference in safety. So Teslas can accurately predict and price if someone is 10 times safer than somebody else, or even a factor safer. And I would say there definitely are drivers that are 10 times safer than others. I think we intuitively understand this as people. If you imagine someone who's a really safe and considerate driver, I think about my own parents, baby boomer age parents that are safe, considerate drivers, have perfectly clean driving records, have a really good vehicle, drive their vehicle safely, considerately. And then you can contrast that with, sort of a maniac, aggressive, reckless driver who's texting while they're driving, changing the music, they're eating food while they're driving, they have the music cranked up so they don't hear as much about in the environment around them as clearly. They're following other cars bumper to bumper, swerving back and forth, cutting people off, taking aggressive turns, speeding, slamming on the brakes. These kind of drivers are the ones really that more typically are going to cause the accidents of the world, and especially the more severe accidents of the world, versus a really safe, considerate driver. So just kind of point that out intuitively. I think we understand there really are pools of drivers that are already just in the normal world 10 times safer than other much more dangerous drivers, maybe even more than 10 times safer. And now if somebody is 10 times safer, just because they are a more considerate driver and they're driving a Tesla, which is a safer vehicle to begin with, the financial results do become staggering if you can know that someone's 10 times safer and you can price them accordingly. Let's break it down. So again, the typical auto insurance structure is 75% of premiums go to paying claims, 15 to 20% go to underwriting, and then 5 to 10% are your profit. That's sort of your typical structure. Now, in Tesla's case, if you're only insuring people that are 10 times safer, rather than 75% of the claims going to premiums going to paying claims, it would only be 7.5%, and then it'd be 1/10 of the 75%, and then you still have 15 to 20% of underwriting and administration. Of course, you could probably be much more. This could actually be lower for Tesla because they're much more digitized and they don't have a network of insurance brokers or other sort of legacy costs like that, so that should be lower. And then overall you'd have 72 to 75% of premiums left over as operating profit. But Tesla won't charge the same amount of premium. Of course, they're going to undercut, so they pass some of those savings on to their own drivers and really attract more people to come to them for insurance. So let's look at some numbers side by side here. So let's assume $2,000 a year in premiums by legacy insurers. So at that ratios that we were suggesting there, you have about $1,500 to cover claims, $400 for underwriting and administration, and then $100 in profit on your $2,000 a year in insurance premiums for a legacy insurer. Now, assume for Tesla, they charge 50% of what the legacy insurer does. So they just chop the price right in half. It's a no-brainer for consumers. You go to them, it's $1,000 per year for the very safe drivers, of which $150 goes towards paying claims. 1/10 of that, because they're 10 times less likely to have accidents. And then $350 we're going to say instead of $400, makes the math a little bit neater too. So $350 we'll say for underwriting and administration, because they're going to say they're going to be more efficient. It could actually be lower, I think, but just because they don't have the same legacy overhead costs. And then you're left with $500 a year in profit. Just an insane amount of profit. They're charging half the rate, $1,000 instead of $2,000, but they get 5 times the profit, $500 a year, or instead of $100 a year. It's a huge win-win for Tesla owners and Tesla shareholders. And if you take this a little bit further, if a Tesla lasts 15 years, a Tesla vehicle on average, and again, I'd say this is actually conservative, then 15 years times by $500 a year in profit, it will give you $7,500 in lifetime profit per vehicle going to Tesla through their insurance. And by 2030, if Tesla's doing a 20 million vehicles, run rate at $7,500 per vehicle, of course, this would mean every single vehicle would have to be on Tesla insurance, which again is not realistic, but I think eventually Tesla insurance will be basically everywhere that Teslas are sold. So eventually I think this will be realistic because people will choose Tesla insurance if they are driving a Tesla. So by 2030, at 20 million vehicles sold at $7,500 per vehicle, you have $150 billion in profit. Give a ratio even of just of 10 to that this profit here, which is way too conservative, and you add 1.5 trillion in market cap, at least I would say, just from your insurance opportunity that's here. The thing is, Tesla will make drivers safer because they will be able to offer precise feedback on how to improve their safety scores. They're actually going to, even if you're just an okay driver, you're not like a 10x safer driver, even with the software that's offered, you could actually probably become a 10x safer driver, a significantly safer driver, because Tesla's going to offer you really precise feedback and motivate you to drive safer so you have a lower score. From their Q3 call with Zach, they had this little nugget as well. They said, the probability of collision for a customer using a safety score versus not is 30% lower. So just the fact that you are aware of your safety score makes drivers 30% safer, which is pretty mind-boggling, pretty insane. This, coupled with their ever-advancing, driver's assistance software, means Tesla drivers could be incredibly safe drivers overall, and then incredibly attractive customers for an insurance company like Tesla to attract or have. And of course, if somebody was a reckless, crazy driver like I described earlier, Tesla is just not going to insure them, or their price will be literally 10 times higher. Instead of $1,000, they'll ask for $10,000 for their insurance premium for that kind of driver, and the driver will go elsewhere to another insurance company, and that company will be left with them kind of as the bad apple. Ultimately, what I love about Tesla and why I feel safe, right now putting about 90% of my portfolio into it, is because they have so many extremely positive outcomes that are all very probable if you look out into the future along the horizon. And insurance is just one of these outcomes. I want to leave you guys with a tweet I wrote sort of mid last year. I said, what I love about Tesla is the long-term probable outcomes range from good to absolutely freaking fantastic. If you just look at an EV-only roadmap, it's a good investment. If you include solar, battery storage, even better. Include full self-driving, and wow, and include future AI offshoots, and it's really mind-blowing and hard to predict from there. But even throw in there, even if full self-driving, say no one ever achieved full self-driving, that was just had really, really good driver assistance systems, at least you could throw in Tesla insurance in here as another part of the overall thesis another sort of very positive outcome in the sort of realm of possible outcomes. Maybe not as good as everybody driving robo-taxis, but still very, very positive outcome for people that are driving their own vehicles themselves. Thanks for watching this video. I'd love to hear your feedback in the comments down below. Make sure to hit that thumbs up while you're at it if you enjoyed it. Follow or subscribe down below. Follow me on Twitter at PaperBagInvest. And remember, it's in the bag.